Good morning. This is Manjit Singh, and I have my backbone here, Kusum, from Manjit Singh CPA office, with the offices in Falls Church, Ashburn, and yes, we are seeing our clients in Ashburn also these days. Kusum, I wanted to talk a little bit more on the qualified business income deduction, since that's the hottest topic possible in this year because it's the first year. All right. So the question that has come up is somebody who is self-employed or a one-member LLC and is renting his own real estate to the business, paying rent. What do you think? Because that is reducing the profit of the Schedule C, and that means the qualified business income deduction is going down. What would your suggestion be?
Well, if the qualified business income deduction is going down, but your self-employment taxes are also going down, and is that property jointly owned, or is it owned just by the sole proprietor?
Let's hope it's all jointly owned.
Then you do have to pay self-employment tax on the one half, right?
Right.
So your deduction is...
Let me make you correction here. If it is one member or LLC or one individual's Schedule C, Social Security will be 100% for that one individual.
Correct.
The rent deduction, if it's $100,000 and the property is owned jointly, the rent deduction is 50%.
Correct.
The remaining 50%, you would throw it up on Schedule E.
Right.
And maybe mark it down there as the other spouse rental income. So now you ended up paying 50% more Social Security tax. I don't know whether that's what you meant, 50%. All right. So you ended up paying Social Security tax more on Schedule C, but you shifted the income from here to the other spouse income on Schedule E, and now you are eligible to take the QBI deduction. I would like to emphasize here that I would make sure it's not considered as a passive income, and that actually, you know what, passive income or non-passive, it doesn't matter. Qualified business income is available to both.
For the QBI deduction.
For QBI deduction is available to both. Whether you want to take the real estate taxes here, 50%, and there, 50%. Mortgage interest here, 50%, and if there's no mortgage interest, there will be no mortgage interest deduction either way.
Right.
Okay? So this is one aspect of it. And this one, we had a situation, maybe was it 15 years ago when we were still at Loman's Plaza? The case is called Cox, where the property was jointly owned and it went to court, and therefore it did not go through. My guru, my tax guru, who's Bob Jennings, and another gentleman, his name is Dave Krebs in Ohio, their suggestion is, instead of trying to keep this complicated and uncomplicated, put the real estate in the limited liability company partnership. In that partnership, you have the ability to manipulate who owns what percentage. Make sure the ownership deed is also of the LLC. Make sure the mortgage interest, the loan is potentially with the LLC. All right. So now, if assuming that, like we have a client physician who is in McLean, and he's a physician, he doesn't get the qualified business income deduction. However, if the property is 50% owned by the spouse, she will get the qualified business income deduction, and the income will be there, the expenses adjustment will be there, and if there's no mortgage interest, the qualification is better, because as a physician, the one spouse will not get it. Is that a good tax planning?
It is.
All right. in here, I would also like to emphasize that the contractual relationship should be there. The third-party contracts also should be there, so that it is legit, not only from surface, but through and through. The rental agreement should be there. The rent should be fair market value, maybe 5-10% more because of the location. So having said all this, ladies and gentlemen, if you have additional questions, you can direct it to Kusun or me. And since I'm running out of time today, this is Manjit. So we'll see you next week.
Thank you for watching.